The looming financial crisis, anticipating chaos and the next major market crash. 1. Economic challenges. The United States is in decline relative to other countries in terms of economic and military power. China has been the leading competitor to the United States since 1984. The Federal Reserve's actions to reduce debt can have both short-term stimulative and long-term depressing effects on the economy. The Federal Reserve and the government created a bubble by providing an enormous amount of debt and credit, leading to a surge in inflation. To combat inflation, the Fed is raising interest rates, which will slow down the economy and reduce spending. The trade-off is between controlling inflation and avoiding a severe economic downturn. The current situation is similar to the 1970s, with high inflation and the need for a beautiful deleveraging to reduce debt relative to incomes. Various factors contribute to the current economic challenges, including internal political conflicts, international conflicts, the costs of rebuilding Ukraine, climate change, and infrastructure development. 2. Currency and inflation. The U.S. dollar's strength is relative to other currencies, which are all depreciating in buying power. The euro is a significant factor in the dollar's strength due to Europe's economic situation and money printing. Money is not a good storehold of wealth when interest rates are lower than the inflation rate. Inflation and currency devaluation are significant concerns, prompting the question of where to store wealth effectively. Traditional stores of wealth like money and debt instruments may become less reliable, necessitating the search for alternative options. 3. Investment strategies. Inflation hedge assets, such as inflation hedge bonds, are recommended as a means of protection against inflation. Saving in essential assets like residence, education, food, and healthcare is advised as a practical approach to wealth preservation. Geographical considerations are important, with countries that have positive trade balances, strong balance sheets, peaceful relations, and low international conflict risk being more favorable for investment. The current intellectual revolution and cutting-edge technologies present lucrative investment opportunities. Diversification is crucial to reduce risk, as losing a significant portion of wealth can be detrimental. 4. Interest rates and debt. Sustainable interest rates are unlikely in the current environment, making debt issuance less attractive. Equilibrium interest rates should be aligned with structural inflation rates, which are estimated to be between 4% and 5%. Real bond yields need to provide a positive return above the inflation rate, potentially leading to a relatively flat yield curve. The economy's ability to withstand higher interest rates without negative consequences is uncertain. As we navigate these turbulent waters, staying informed and proactive is key to mitigating risks and safeguarding financial stability.